welcome back to the Don and Gino Real Estate and Finance Show right here in your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness.
Well, you're going to be so glad that you joined the Don and Gino Real Estate and Finance Show today, especially with all that's going on in the stock market today. And we have our special guest expert on, Chris Ingram with Ingram Financial Solutions, kind of help guide you to what's really happening. Remember, you got the media is going to spin everything in multiple different directions. Even from the same media outlet, they'll tell you a negative and a positive from the same person. So who do you believe? Well, we believe in Chris Ingram because he's calm, cool, and collected. We worked with him now for 7 years being on our radio show. He's part of our group called America's Professional Resource Group for a reason. And we put together America's Professional Resource Group as in aprgi.com. Find out more, aprgi.com. This is a group of the best professionals we can find to help guide you to personal and financial wellness. And Chris has done us a service over all the years, plus educated us on a regular basis to where we're more than know. And Chris, I'm going to start off with a comment I made on the break because we're bringing you on to help a lot of our listeners out there go, what the heck is going on? And you've been on our show now. This is the third time after a correction. We're going to talk about a correction versus a crash. And your demeanor, I was saying, is so much different than even 7 years ago when we had an 800-point
I think it was a 900
decrease.
point.
It was 800 or 900-point decrease in the market. And you had more people calling. You had a lot going on. This time you're like, we got this. Only a couple of people asked questions. Or me, I asked you one simple thing. Hey, I'm not panicking. Don't worry, bro. Is this a buying opportunity? Because I got some cash on the side waiting for a correction. Right. So we kind of saw it coming.
Right. Yeah, and part of that I think is that I'm getting old and it's close to nap time. So
you're still way younger than me, puppy.
Yes,
That's why I see you at the gym lifting twice what I lift.
Yes, I am calm because nothing spooks me. Even a crash doesn't spook me. I was talking to clients the other day. I'm actually looking forward to that next crash. I mean, if we can kind of sidestep it, not get beat up during the crash. I mean, you look at the years following crashes. I mean, you're talking about 30+% moves to the upside, 50% moves to the upside. There's great money to be made in those time periods. So bring it on. I mean,
I've enjoyed this run. Gino and I both look at our portfolios that you handle for us, and it's a good time. I mean, some days if I had a bad day, I just open my portfolio. I'm like, it's up 30 what? Okay.
Right. Well, and we've been talking about this, and you know, when you get a bull run like this, that tail end, the 8th and 9th inning of the bull run is this euphoric, money starts flooding in. You start seeing big rally, you know, right at the end of this bull run. And so you start getting to a place where valuations get stretched and the retail investor has jumped into the market and they missed the first, 8 innings of it. So now they're all piling in. And
not to digress, but that sounds a lot like cryptocurrency lately.
Yeah, 100%. Yeah.
I mean, what did you see? You saw something go from like 6,000 to almost 20,000, now back to like 7?
Yeah.
Yeah.
Well, and the cryptocurrency.
It's a whole different show.
Yeah.
But I mean, it's a similar,
don't go there.
similar emotional reaction by buyers and sellers and exuberance.
And a friend of mine posted a picture today, and it was a wavy line, and at the top of the line, it was like the market goes up, and it said greed, buy, 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 and then the market went down, and it said down here fear, sell, 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 and it was saying basically that's the mentality typically, is this euphoric, like, wait a second, the market's really good right now, I need to buy, buy, buy. And then when it drops down, everyone's like, man, this is terrible, I want no part of this. And they're selling, and they don't even want to turn on CNBC, and they don't call their advisor, and they're out. And if you listen to a guy like Warren Buffett, he's the exact opposite. He's like, I buy when things are on discount. I buy my socks when they're on sale, and I buy my stocks when they're on sale, and I like them when they're cheap. Investors really need to. Investors really need to figure out how to work within the flow. What has been happening recently is you've got a market that has done very, very well. It started off this year with another crazy run. I mean, like I said in the previous segment, S&P 500 was up over 6.5% in January. Okay, that's after 18+% year in 2017, to jump 6.5% in January is ridiculous.
Right.
I had clients that had individual stock accounts that were up 17+% just in January. So when that happens, you have to assume that there's some real possibility of a near-term pullback or correction in that market. And if you were caught off guard, maybe at the speed that it happened, I can understand. But if you didn't think it was going to happen at all and the market was just going to continue that pace for 2018, you were kidding yourself. So that's why we already kind of saw it coming. And,
It was like,
we were prepared for it.
If, it's when, right?
100%.
And you know, you ultimately.
I didn't even like flinch, honestly. I'm like, oh, here it is finally. I mean, it actually was long overdue, I thought.
And look, so you take some positions. Sometimes you're willing to take more risk, right? Like we talk about. I'm a very high risk investor. I take a lot of risk. We've done very well doing it that way, but my time horizon is very long, and I think that has a lot to do with, you know, we talked about. I was like, well, I guess I'll stay in that position longer, and that's kind of the illiquid thing. Hey. 5 years from now, 10 years from now, that position will be just fine. Maybe even 2 years from now, that position will be just fine.
Yep.
You just stay in it longer. That's all you got to do is wait longer.
Yeah.
Yeah. I mean, there's only one person that takes more risk than you. That's your wife.
Took
risk.
a lot of risks 15 years ago.
Sorry, just had to
married,
throw it
right?
out there, man. And then she's just waiting it out.
Wow. There is a good life insurance policy. She's just waiting on that.
Yeah, exactly. Okay, let's talk about the crash versus correction. We talked about, you know, why we're not panicking. You're not panicking. We didn't panic at all. We saw it coming. We were actually waiting for it. Those that are investors, those who are educated and pay attention, actually were excited about it in some ways. Believe it or not, I was like, okay, finally it came, because you. If it kept going higher, that the fall was going to be harder, I felt. So we needed the correction. And explain why we understand, of course, why we're not afraid, because it's why it's not going to be a crash and why we're not afraid.
Okay. So crash versus a correction. Corrections are healthy. Crashes to some degree are healthy too, but corrections are definitely healthy. That's a readjustment of valuations, money moving from one sector of the market to the other, making adjustments to portfolios. All of that is in the natural cycle of portfolio management and the markets in general. So it's not something to be afraid of. It is. It's necessary. It needs to happen. Yes, I'm constantly getting new clients with new money. Clients are coming to me with new money. We're looking for those little, I mean, we get excited for those little opportunities to say, okay, great. We wanted to buy that stock. We thought it was a little overpriced. It came down, 10% in this move. Hey, let's jump on that thing. Let's go ahead and get a chance to buy it.
Yeah, like we bought Amazon at a quasi very expensive price 3 years ago. That worked out okay.
Right.
You think?
So
I think my Amazon's up like 9% or something like that.
right. So what happened? So you go back to last week. We got jobs report, we got some wage growth numbers, and we got all this positive data that pointed to the fact that this economy is doing pretty darn well. And so what happened is that rolled over into, oh my gosh, maybe we're doing too good, and now we've got an inflation issue that we're going to have to deal with. And then what is the Fed potentially going to do to curb that inflation issue? Well, they're going to raise rates faster than what we previously expected. So everyone went into panic mode of rates are going to go up faster than we thought, and they started using that as an opportunity to exit and hit the sell button.
Well, what they're saying, I want to clarify, the fear is if rates go up too fast that it'll actually stagnate this great growth in the economy we have. Because they're like, wait a minute, we're on a streak, don't stop it.
Right.
Is the fear, basically.
Right. So the interesting thing about that is I don't think a lot of people took enough time to evaluate the situation, but that's going to straddle companies that have debt. So you have to look at, if you're really doing your homework right, you have to look at what companies you're invested in and how much debt do they have, how much debt do they need to operate. A company like Apple has all this cash laying on the side. It's not going to really impact them whatsoever.
Nope.
So, so you have to look at those things and see, okay, who would higher rates impact? And then take that into consideration who you invest in going forward.
Yep. And we said that from the beginning, from a portfolio management standpoint, these tax cuts that we're getting, and that's another thing, is everybody felt like this tax reform is almost too good. It's like throwing gasoline on a raging fire. Like, oh my gosh, we're already doing really well, and now we're going to get all this extra, and it's going to be just too good. Inflation is going to be crazy. But with those tax cuts, what a lot of people have been talking about is the biggest benefit's probably going to come to medium and small size companies here in the U.S. But those are also the companies that get hurt the most by rising interest rates.
Because they're more leveraged with debt.
You got it. So you start looking at, hey, should we own those medium and small size companies because of the tax benefits that they're going to get? But also, everybody starts to worry about, hey, if interest rates go up too fast, that may offset the benefit of the taxes. And so how far do you go into those small and medium size companies?
I know Don wants to cut me off. So when we come back, I'm going to ask you a question that's loaded with that, because you may want to give some people credit for why that tax reform came at this time.
Ah, I like it. All right. Great stuff with Chris Ingram with Ingram Financial Solutions on the Donna and Gino Real Estate Finance Show, talking about what's really happening in the financial markets. And boy, have we had quite the ride, and we're going to go in more in depth, and you're going to be more in the know than anybody else at the water cooler when we come back to the Donna and Gino Real Estate Finance Show.